Good afternoon. We are going to start a new model on your postgraduate diploma in postgraduate management, and the new model we call it risk management, and it's a very important subject. In banking, we do business, and when you do business, always there's risk. Therefore, this is a very important subject. I will go into details of each type of risk we are going to undertake in banking. Before that, let me introduce myself to you. My name is Christine Anakkara. I'm an associate member of the Institute of Bankers, and also I have a diploma in Chartered Institute of Bankers, London, and then I have a MBA from University of Sydney, and I'm also an accountant. I have a certified management accountant. So this subject I undertook to lecture here for last maybe about 6 years, and the last employment which I had was actually, now I'm a retired banker, and my employment record is back to about 40 years, and my last position held was a Deputy General Manager or Chief Risk Officer at Ceylon Bank. So I welcome each and every one of you for this particular program. Let's go to the subject matter directly. I named this as financial sector risk management because I believe each and every one of you are either employed in a financial institution. So risk management, though, is a wide subject, I limit to risk pertaining to financial sector risk management, since you undertake in your business matters where financial sector concerned. So we'll go on. If you see this slide, you can see there are two ships, and the wording says ships in the harbor are safe. That's not what ships are built for. Similarly, I can relate this same slides. If you want to do business, you need to take risk, and ships are also built to sail, and as a result, they have to come out of the harbor. Once you come out of the harbor, they face risk. Similarly, when banks open doors for customers to transact with them, they come across various types of risks, which we are going to discuss in detail. And we move on to the next slide. You see, if you have any questions, you can ask while you're looking at each slide. I would like to go back again to my former slides. Banking is a business. So banking, when I say business also need to take risk in order to make profit, to add value to shareholders and to all stakeholders, including employees, including customers, because they are stakeholders. You need to give loans, and you have to undertake various types of risks. Moving on to the next slide, I have put the financial institutions which come under the financial sector. You can see we have central bank first. Central bank is, we call it a regulator, or we call it the godfather. Central bank gives us all directions, and banks and other financial institutions. We call it, banks are called licensed financial institutions. Then we call it licensed financial institutions, and we also have licensed finance companies and leasing companies. They are called non-banking financial institutions. So we have banks, we have finance companies, we have leasing companies. On top of that, There's another kind of financial institution we call primary dealers. They also make a great contribution to financial transactions because through a primary dealer, you could trade in government securities like bonds, treasury bills, so on. So primary dealers also part of financial institution. Then you also get money brokers. Money brokers also play a great role. They arrange, they have various type of debt instruments which if you need finance, or these primary dealers through money brokers, they trade in bonds and various things. You also have securities firms. Securities here, I mentioned it's equity. Equities are also stocks. These companies are called stockbrokers. They also trade another financial product. We call it stocks. And finance companies sometimes they fund these stocks for customers to trade in. Under financial companies, you also get insurance companies because insurance also one of the major funding arm of these financial institutions. We also have pension funds, unit trust, venture capitals, and also those who fund micro level of business is also called microfinancial institutions. So you can see financial sector constitute a large number of players and they have been regulated by Central Bank of Sri Lanka. And if you violate such regulations, we call it compliance risk. So it's another subject we deal with our regulator, and banks or the financial institution companies need to follow the regulations laid down by the Central Bank of Sri Lanka. So this is the financial sector what it constitutes. Now we move on to our subject matter. You can see I need to give a definition to risk. Before we start management of risk, we need to manage and understand what is risk. In simple language, risk is a chance. We'll say in this chance, either you will lose or you will gain. When you take a chance, you always take a chance to gain, but there are times that you will tend to lose. If risk factor is higher than the reward, you tend to lose. We'll take for an example. In your daily life, sometimes you go and buy these lottery tickets. You go to a lottery ticket holder and pay 20 rupees and buy a ticket. Your objective is to win the prize. Sometimes when the results comes on the draw, if you are a winner, if you more than what is your investment, you are a winner. And in that case, you have a gain. If your numbers doesn't match the winning numbers, you tend to lose your investment. And that risk also you have taken, because that's why I call it a chance. Sometimes you might get, for your 20 rupees, you might get a 10 rupee. Or you might get even your 20 rupees. So you are neither winner nor loser. So the risk what you took had paid you to get your money back. But if you win more than your investment, the risk what you took has given you opportunity to earn more than what your investment is. So in other words, if you see these slides, if you lose your investment, or if you intend to earn more than your investment, but certain uncertainties, your objective is to earn more than what you invest, but certain uncertainties. That means your numbers doesn't match in your sweep, you might lose. So this uncertainties, we call it a risk. And I told you it can be a positive or negative. If your risk, what you take, will give you a gain, then we call it a positive. If it lose, we call it a negative. I also must say here, business cannot be conducted without taking risk. Therefore, banking is a business, and what we do is also take risks. And while doing this risk, banks are generally not gamblers like what you buy a sweep ticket. We say we take calculated risk. So our subject is to, my understanding is to teach you the risk management is to do that calculations and see that your objectives have been achieved and you get positive results. So moving on, we need to look at a little bit of history. And the history of this particular subject, it comes from various events that has taken place in the past. And the first time what they thought that risk management would be an ideal subject for us to study came from a debacle in USA. There was a company called Enron, and this particular company was based in Houston. They were a trading company. Mainly they were dealing with oil, and became one of the largest US companies. They were, in fact, they were the 7th largest company in US at the time when this collapsed. What do they do is they have various branches, or I call it a shell companies, in various parts of the world. They predict the price of oil for the coming 6 months, and they undertake orders to supply oil at whatever they think ups and downs taken into consideration, and then they quote the price for various countries, various buyers in various countries. So these particular shell companies, they quote, will say oil was trading, we'll say at $60 per barrel, and if they think oil prices will go up to 80, they will take orders at the rate of 80 or more. And at the time of actual sales, if the price in the market is less than that, they can make a profit. If the actual price is even more than the amount what they have undertaken, they make a loss. So these shell companies, through various dealings, had some losses, which they didn't report to their head office. They were kept in suspense accounts. And as a result, the Enron particular company was making profits because oil has been sold upfront at a price. The sales have been already booked and the profit has been computed. And when it came to a situation where they also got engaged, their chairperson got also engaged in various political activities. The Enron chairperson was to become the president of the Energy Board of USA. So he supported the presidential candidate by various of funding his campaigns out of the company funds. So while doing this, he also got into very irregular activities, and we call it, they cook the books. That means though they don't have actual profits, but in their books they showed book profits. So the share prices were soaring. When this activity was revealed to the investors, they got panic. They started selling shares, and before they really identify the exact loss, share prices plummeted to from $90 to 70 cents. As a result, the company went bankrupt, and in fact, the auditors were sued. Their chief executive was sued, and now they are in jail. So this fiasco is what you call, in accounting we say they have cooked the books. As a that name, cook the books, in accounting jargon came into known only with this Enron's debacle. So this was one of the major event where in risk management the history records. So in fact, their auditors were sued. Auditors were one of the major audit company called Arthur Andersen. Even their executives were taken to courts and they're jailed. So this event gave the world to be careful of your investment. Take care of the risk your company undertakes. Where banks are concerned, the first banking debacle came in a bank called Rm Bank. You must get hold of this book. The book is named The Rogue Trader. And this Rm Bank is a 125-year-old bank in the United Kingdom. And they have office in the Singapore, in the Asian sector. Their Singapore office was operating from, they were dealing with all Asian countries. Rm Bank is mainly an investment bank, which they trade in shares, they trade in bonds, treasury bills of various countries. Also, they trade in foreign currency. As a result, one of the London office had a person called Nick Leeson. He's an executive in London office in their treasury. He showed to their board that all the dealings or the trading what he had done resulted in good profits, and he made massive profits for this Rm Bank. Then they chose him to be the head of their Singapore office. While in Singapore office, he undertook various tradings and he recorded losses. Trading, I told you, when you're in trading, you foresee a currency exchange rate will go up and you buy that currency. Unfortunately, if that currency remain at the same exchange rate or drop in price, you make a loss. Similarly, you buy a bond undertaking that you can make. Bonds are for long-term investment, but this investment bank doesn't buy bonds to keep until its maturity. What they want is when the interest rates goes down, they are high valued bond, high interest rate carrying bond, they will sell at the market and make a good profit. But however, Nick Leeson failed in Asia, and all the businesses what he undertook in Asia resulted in losses. What he did was, these losses, instead of debiting his P&L, he debited to a suspense account. And therefore, the head office didn't know that he has made losses. As a result, what happened, when the auditors from the head office come and identified and queried about this outstandings in their suspense account debtors, they came to know that he has made several number of wrong trades. As a result, he made losses to the bank. Apparently, these total losses exceed the equity of the bank. That means losses were amounting to more than the capital of this particular bearing bank. And generally, if you have losses more than your equity, the banks will have to declare bankruptcy. And this 125-year-old bank declared bankruptcy just because of one person's, some says it's fraudulent activity or his uncontrolled activity, which he undertook to make profits, but has gone the other way because he has undertaken risk. Those risks have not resulted in positive manner, but a negative manner. Therefore, he was jailed later, and there was a book published on him. It's called Rogue Trader. And if you happen to read this, you can understand the story. So this is one of the two events which I could quote as past events of risk. One is from the banking sector, other one is from the manufacturing or trading sector. So we are in future, we are talking only about the banking sector. Risk management has two parts. We categorize them. If it is an enterprise, we call it an enterprise risk management. But if it is in a financial sector, we have so much of risk types. Therefore, we call it integrated risk management. We'll move on. I also must say that we do business in order to make money. And while doing business, we undertake risk. And some of the risks can be preventable. So in banks, generally, risks arising from operations of the bank. Operational risk is called people, systems, processes, and internal events. If you have good internal controls, we could avoid all the risks arising from this sort of risk. So these risks are called preventable risk. Then any business we undertake, we do certain strategies. Those strategies are to earn money. Like you give a loan thinking that the customer will pay. However, what happened if this particular business which took the loan could go bankrupt? As a result, bank may have a credit risk. Bank also can make investments. Our investments, like in stocks, you buy a stocks, will say for 100 rupees. If the stock price goes up to 120, you make a gain. If it goes to 80, you make a loss. So those are strategic decisions taken by the bank to make more money. And these risks need to be mitigated through reduction of probability of occurrence. Now say that's where real risk management come into scene, because we have undertaken certain business in order to make profit, but if the risks, the calculated risk is much higher than our calculations, we can make a loss. As a result, those strategic decisions will result in losses. So mainly we are concentrating on this type of risk where you're trying to make money, but due to certain risk in that particular transactions, your objective of achieving profit, what we anticipated at the beginning, may not arise. As a result, what will happen is you make a loss. So we'll be dealing with that subject in thorough in our course. 12 weeks of lectures, which may include past papers and also a discussion on individual assignment. So the other one is the risk which is arising from outside. Now this is events outside business. Sometimes it's beyond the control of the business undertaker. We have last 2 months, we were under lockdown situation. We never expected a virus could create such a big disaster. Countries to lock down people from doing their day-to-day activities. Those are not in. So those are not actually in the strategic way of doing business. It's an external source which has allowed us to stop our business to a certain number of days and to change various ways we are doing business as a result. You take these type of events will make a huge impact on our business. I introduced something like natural disasters, political and macroeconomic changes. Now this COVID-19 has changed the economy into that extent. We have so many macroeconomic deviations. As a result, we face enormous risk in our day-to-day activities. These risks can be identified through research, or in risk management, we have a mechanism called stress testing. And stress testing is, we will deal what the stress testing is to actually see the future, the events that could happen, which will impact our business. So we'll be dealing that on our way forward. To give you a brief idea of risk once more, I also draw attention to this particular slide. Are there any questions? This has the chat ability, so you can either come on chat and pose a question, so you could interrupt me at any time, and therefore this is open for interaction, because we are quite used to face-to-face interactions at class level, but the COVID has changed the whole gamut of how you do a presentation. So we are looking at a slide. You're at your computer and I'm here, and we'll see what we are on display now is the traditional risk universe framework. You can see I have divided that into 3 categories. Mostly risks come from the environment you operate. Banks operate on an economic environment, and this environment of business, we generally call it a very dynamic environment. Dynamic means subject to change. Your exchange rates will change overnight. Interest rates could change based on decisions taken by central bank. So these changes in the environment will affect our business. Now, also, in Sri Lanka, we have 26 banks, twice number of finance and leasing companies, they say about 56. So they compete each other for a small piece of cake. They compete for loans and advances. They compete for fee-based activities. As a result, we operate in a very dynamic environment. So your competitor also will impose certain risks. Your customers' wants. Now, customer, we call it a king. Forward you various type of requests for you to oblige, but then you calculate the risks involved in those requests and you make your statement. So these customers change of customer bonds also has changed the environment. Those days, if you want a loan, some people even fear coming to the bank because they say bank is closed, it's an air-conditioned place. And we don't know that we will be welcome there. Therefore, but nowadays, there are so many banks. Every township has a branch. So it's like another shop for them. So they can post their or make their request to one particular financial institution. If not, they can go to another. They are in a position to shop around. So as a result, the environment has become so competitive. Similarly, we also have technological innovations. Those days, if you want to do a banking transaction, you have to see that to do the transaction within the banking hours. The banking hours are from 9 to 1:30. But now you have various channels of doing banking transactions. You have ATM, you have internet banking, you also have phone banking to do your transactions sometimes 24 hours a day. So these environments also has created various risks to the bank. So similarly, there are other risks in the matter which we'll be discussing: the shareholder expectations, capital adequacy. When you deal with countries, especially if you are dealing overseas customers, they also have their country risk or political and sovereign risk that will affect you. Then also the legal environment we operate. Every transaction what you perform will amount to a contract, and if you fail to oblige your part on that contract, you can be sued. Similarly, banks are under regulatory supervision of the central bank. We call it compliances, and if you don't obey the compliances, you also run the risk of compliance risk. Industries also have their own inherent risk. Banking industry is generally, we say, one of the stable industry. However, in a situation of like COVID, the economy, when the economy doesn't perform well, even our finance sector may not perform well. So financial markets include primary dealers, secondary market, money brokers, and shareholders, the stockbrokers market. These also will create risk situation to the bank. Then catastrophic losses are what is coming from the environment, which we may not be able to, like floods, fire, tsunami, and various other things. So these environments only you're working. Your banking business is in this environment. And if environment poses certain risks, that will affect your business. So we'll look at the next stage in banking. What do you do? Generally, you process transactions. Those transactions are processed in order to make money. So we identify three major risks in banking. The first one here on this page is called market risk. We also call it price risk, interest rate, currency risk, equity risk, commodity risk. Various things are market instruments where banks also make investments. When you make investment, when I told you first, either you can tend to make a gain or you tend to make a loss. If your investments goes in the right direction, you make a profit. Next major item is liquidity. Banks need to maintain liquidity in the bank in order to service their customer needs. We call it this particular type of risk. Banks, we also call, if you don't maintain liquidity, you are suicidal. So If you want to keep your customers happy, and you need to make your cash flows right. Then we also, our bread and butter, on one side is deposits that will help your liquidity, on the other side is your credit. And if your customers who borrow from you doesn't pay, that will amount to credit risk. Then all these transactions need to do with your human resources. Human resources need empowerment to act. I have put here leadership. Leadership comes from your CEO or the board of directors. So when you have this empowerment and the right structure, your processes can make you profits. One of the latest we just discussed about technological innovations will pose us another type of risk. We call it information risk. Because you work on an internet platform which a rogue could access and use your data to do transactions, and those transactions or fraudulent transactions will lead to losses. Then I move on to operations. Banks has an operations department. Banks do operations. Our operations include all transactions. All transactions are processed through an operational procedure. And if you do mistakes in your operations, like errors, omissions, which also will result in losses. So one of the major risks come from operations. Governance. We have one particular module for this. We call it a corporate governance. Your board of directors need to abide by the regulators' corporate governance rules running the business of the bank. And this also poses a lot of dangers if the board doesn't give the right direction or they didn't oversee the operations of the bank. Reputation is also important. Reputation here I say is, we accept deposits from customers. If bank doesn't have a good reputation of serving the customers well, undertaking their requests well, and keep their entire stakeholders happy, your reputation may come to may subject to scrutiny by various stakeholders. If you lose your reputation, you may not be able to get your deposits. You may not be able to conduct your business properly. Integrity is the trustworthiness. People place money in the bank because they trust. So we need to keep the integrity. If you get news like management has fraudulently taken the depositors' money, your integrity will be lost and you may not be able to conduct your business. So these are type of risk in our universal risk frame, and these need to be reported to your senior management, to your board of directors, and also you need to publish certain results of your bank in annual reports, in newspapers, for investors to identify that your bank is operating, your processes are risk-free, and the customers' money are safe. So moving on, I have a question here. And I need for you to understand this question very well. Why banks are different from other businesses? Now, going back the history, I show two different events, Enron Company, whereas Barings Bank. Now, to demonstrate this, we need to see I'm going to the board to simplify two things. That means I'm going to the board to give you a sample, very simplified sample of our balance sheet of a bank. You say current assets plus fixed assets equal current liabilities, long-term liabilities plus equity. I hope you can see this. This is a balance sheet of a bank, or if I am to elaborate what is this current assets of a bank, banks need to keep cash. Bank has investments. Bank also gives loans and now looking at this, our current assets include cash, investments. Generally, banks are supposed to keep from their total assets. I will put the total assets of this side 100 and this side 100. Generally, in a bank, about 90% of your total assets is equal to your current assets. So this will become 10. And our regulator says, in order to serve your customers better, you need to keep at least 7% in cash. This cash includes your balance in the central bank, your current account balance. The money what is in your safes, on your counters, and also in your ATM machines. This 7% of liquidity requirement is needed to serve your customers. Then they also says you need to maintain 21% of your total current assets in liquid assets. That means which can be converted to cash when there is a requirement. So to make this requirement of the regulator, we'll say 14% out of this 90, 7 is gone to cash, 14 has gone to your investments. So the balance, which is 69, consists of all credits what you have granted to your customer, entire loans and advances. So you can see your loans and advances, or the credit what you give to your customers, has become a major portion of your balance sheet. In a normal company, they don't lend. As a result, they only give credit for a 1 month or so. So banks' position is different. In a normal company, you will have cash. Sometimes even the cash is not there because they take a overdraft. So their bank balance are overdrawn. Instead of investments, they have debtors. That means if they have sold anything on credit, they have debtors. Instead of loans and advances, but they have heavy stocks. which need to be sold. So banks are quite different from a normal enterprise which do trading. So I will go back to that slide once more. It says function of a bank is financial intermediation. What do you understand by financial intermediation? Financial intermediation is like money lending. You take money from people who has excess, or we call it economic agents with surplus money, which they don't want to do business, but they don't want to undertake any risks. They would like to deposit that money in a bank and earn interest, and you use that money as a banker. We give it to another economic agent who are actual risk takers in enterprises. They would like to take your money and they would like to make more money by doing trading, manufacturing, and various other activities. So intermediation is we go in between. You are a middleman. Bankers act as a financial intermediator. So what we do is we mobilize deposits from public and lend. We have fixed assets. You can see our balance sheet which I show. Out of 100, only 10 are fixed assets. Fixed assets include certain buildings. Most of our buildings are on rent, therefore it's not belongs to us. And also we have assets like our computer systems and so on. So we also have a low fixed cost. That means we don't manufacture, we don't have plant, we don't keep raw materials. Our raw material is money, and money that we borrow from customers. So most liabilities are payable on demand. So if you see, now I'm going back to my board again, and on this side, current liabilities include deposits. We generally say if you have look at what I have drawn under current liabilities, most liabilities are payable on demand. Say even if you get a fixed deposit, sometimes if a customer needs such deposits in advance, we tend to do a premature upliftment. So that's why we maintain such a amount of liquidity. 21% of our assets are to be maintained in high liquid assets. That means we need to convert those assets quick into cash, because most of our deposits are payable on demand. You also operate with low equity. Now, if you go back again, under equity I have put 10 because generally we have a regulated requirement called capital adequacy. You need to have 10%, which had been increased to 14% in recent times. So in this example, I have put 10 out of 100, which is 10%, and considered as a highly leveraged business subject to regulatory requirements. Now you need to understand that this word, highly leveraged, how do I explain this? If you have done your financial analysis in your previous ratio analysis in your previous lessons, you would have come to know the equation or the ratio called debt equity. That means your total, your debt, what you have borrowed, by a customer, that is the loan what we're going to give to the customer, against the capital which is going to contribute. Now you look at a certain customer, will say, I'm a customer comes to you as a banker. I will say, I have a project which all the relevant valuations or evaluations have been done, and if this project could be funded, I could make more money, and I would say this project needs 100 million, and I will produce my contribution as, we'll say, 25. It means 1/4 of the project is being contributed by the businessman who proposed the project to the bank and request banks to provide 75 million, which is 3/4 of the total funding. Generally, in project finance, we call it, this is equation of 3:1. So I will go back to my equity again. You can see equity in banking, your deposits is the debt. That means what you have borrowed from money, which is 85%. And your equity is 10. That means the bank's shareholders have contributed only 10, whereas you have borrowed 85. Even the other 5 is made long-term liabilities. Long-term liabilities include this 5 is called debentures, also belongs to investors who made their investment in your bank. So hello. So debt equity here in a normal company where the borrower whom I propose as a project lending customer is proposing his contribution of 3. His contribution is 1. Bank's contribution is 3 in a project. Now, if you look at here, bank's contribution is 10. Customers contribute 85. This debt equity is 3:1. Here, 8.5:1. That's why I call it bank is a highly leveraged business. And I must say, a banker will not lend unless customer bring 1/4 of his contribution for a project proposal of 100 million. Now, similarly, now imagine how come your depositors, knowing that bank's equity is only 1, they bring 8.5. So debt equity is bank having a very high debt equity ratio, which is under normal circumstances, it's not an investment decision. But you know, banks are highly regulated. Central banks give a lot of directions and guidance how we operate. As a result, the people who supply money to us, mainly depositors, have the confidence in making their deposits in banks so that we could run our business. So one of the major difference in a normal business and a banking business is that we are highly leveraged. We operate in low fixed assets, and we mobilize deposits from public. To all that, public confidence is a requirement. So that's why we follow all the rules of our regulator, Central Bank of Sri Lanka. Bank also has another responsibility, we call it a fiduciary responsibility, to protect customers' deposits. In recent times, this deposit insurance scheme has come. As a result, people have more faith. Otherwise, completely based on the confidence, they place their money in the banks. So we have a fiduciary responsibility to protect those customers or deposit customers when they make their deposits in the bank. So these are the two major differences a normal company compared to a normal company the banks has. Before coming to subjects, I go a little more further on the risk. Banks operate, I call it a balancing act. Banks want profits that I have put here, and profits can be generated by doing business. When you do business, you take risk. So this is where we are concerned, how we take risk in our program. While taking risk, you grow your assets. When you give loans, your loans and advances will go up, your balance sheet will go up, your growth can be achieved. When you have your growth achieved, you make your profits. So this managing this balancing act, risk management play a very vital role, because to making profits, if you don't manage your risk well, you neither will have growth nor profits. So as a result, risk management has become a very critical subject matter in banking. As a result, it's directly come under the supervision of the board, and board is responsible in forming a complete risk management framework for the bank. Now we are going to go for the subject proper. In a financial institution, the type of risk we undertake. This is a very important slide. We will look at, there are 3 slides, 3 circles going on top of each other. And in between you have a hub. So I call these 3 cycles are the major risk in banking. So I go from my right, which is, you can see financial risk. We are a financial institutions. We deal with money. And as a result, major 3 financial risks we undertake is credit. You looked at our balance sheet proper. Out of 100, 69 is given as loans and advances. And this particular portion is your total loans and advances. If that will result in credit risk. So one of the major area, or where your balance sheet is concerned, major area of risk management, we consider credit risk as your major portion of risk in the balance sheet. Then we also looked at, in my sample balance sheet, I also said investments. Banks need to keep 21% of their total assets in liquid form. And to make liquid, you can keep, if you keep 21 in cash, what will happen? You can lend only 69, the others will not earn any money. And as a result, you will not make profits to the extent you intend to make. Because when a customer deposits 100, if you are going to keep 21 idle, and whilst you are paying interest to that 21 to customers, you make a loss. Therefore, you make other investments, like investments which can convert back to cash very quickly. You can trade in treasury bills, you can trade in treasury bonds, which could be sold on a market rate at a given date. And also you could have positions in foreign currency. You can hold foreign currencies in your balance sheet. And if the exchange rate goes up, you make profit. Exchange rate goes down, you make losses. Those are all come under market risk. So next item in your financial risk is credit and the market risk. Third item is the liquidity. I told you it's suicidal if a customer demands money and if you don't have money to pay. And next thing what will happen is your reputation will be questioned. Customer will lose the confidence in placing money in the bank. As a result, your entire strategic way of doing business will be lost. As a result, you may have to close down your business. So the major risk in the financial sector is financial risk. Financial risk consists of credit, market, and liquidity. We move on to the cycle on the left, which is strategic risk. If you can remember my second slide, which I say when I'm identifying, third slide rather, identifying, we say we do business. Business are done based on various strategies. So strategies involve your customers, your competitors, and any stakeholder, where you make your processing of transactions and your decision to do business, to grant a loan based on your strategy, to make an investment based on your investment strategy. So this strategic risk is to do with your customers and your competitors. And it's a very important area, because if to do in business, you need to take strategic decisions. As a result, most of the banks, generally they have a strategic plan running for 5 years, which is linked to your budgetary process, which is linked to your risk management, because risk management will tell, or they will also participate in your strategic planning session to identify the risks which you may face in the future. As a result, your profits can get affected. So therefore, you change strategies, you change your procedures to do business. So strategic risk is a very important area. Banks allocate a lot of funds for this. Because you have to deal with your competitors, you need to keep your corporate image going. You do a lot of advertising. Banks have a huge marketing budget to maintain their corporate image, the public confidence, and to give a fair knowledge about the products at bank markets, so that you could attract customers to do business with. Then the cycle on the bottom is, I have put as operational risk. Moment you open your business for public, you are subject to operational risk, because operational risk I have classified earlier as something to do with people, something to do with your system, something to do with your processes, and also external events may affect your operations. Your people can do wrong calculations, errors, omissions. As a result, transactions can be loss-making transactions. Your trader will undertake a future currency rate. However, the time comes when it comes to maturity, if the currency has not reach that level, you make a loss. Those are kind of strategic decisions, but you're given a platform to trade, then as a result, lead into operations. So any omissions, errors in executing transactions by people are, we call it operational risk. Your processes, bank, we do our business through various processes. For example, we'll say you undertake a fixed deposit. So what do? You give him a form and you make sure that all the columns in that form are filled, and you inspect. Then you accept the cash. The cash will be sent to the cash counter. You get a receipt that cash has been deposited. Then you type out a fixed deposit receipt to this customer. Then you hand over. So this process is the process where the process will give you a deposit, but it has to done in the system what has been laid down in your operation manual. So if you deviate from these processes, sometimes will result in losses. Those losses are called operational losses. External events also could affect your operational risk, like unexpected fire, flood, also could affect your operations. As a result, losses you incur based on those external events, or even a robbery. If you make a loss based on a bank robbery, those are called operational risk. So operational risk also to be managed, and it's a greater risk in banks because now, not like we are opening our branch. We call those days the banking is a brick and mortar operation. Brick and mortar means you have a branch made of bricks and cement, and you need to go to this branch to do your transactions. But now the platforms have changed. You have various type of delivery channels. You have ATMs, you have banking, you have internet banking. You could do transactions in various ways, sometimes 24/7. As a result, you have various systems supporting this longer period of transaction time. And those systems, if something goes wrong in this system, and as a result, if you suffer a loss, we call them an operational risk. And there's a separate part on this. Under operational risk, there's another part we call it information risk, because based on these extended channels or channels of delivery on electronic channels, this information security is one of the most important area. Apart from these 3-4 major is in the hub, I have put in yellow, all these risks are under the supervision of Central Bank of Sri Lanka. If banks undertake risk, they need to oblige to the rules and regulations stated by directions and the Banking Act of your regulator. Your regulator of is Central Bank of Sri Lanka. And if you don't follow the regulations, or if you disobey the compliances of the regulatory body, which is Central Bank of Sri Lanka, you run the risk of regulatory risk, or we call it compliance risk. This is also another major area which we will be dealing in a separate section. Apart from that, I also have identified a few other risks we call reputational risk. You know, if our customers are not happy with your performance, your service, or you are involved in certain fraudulent activities, your reputation is subject to customer unpleasantness, you will lose business. Similarly, all the transactions you undertake, including your employment contracts, as employer, bank need to make the obligations right. Whatever obligations you agreed on that contract, you need to make good. If you fail, somebody can sue the bank, and that we call it a legal risk. I also told that we do most of our operations, apart from the branch bank, apart from the brick and mortar operations, we do on a technological platform. The internet and the phone banking, ATM come under technological platform, and this need to be updated on an ongoing basis. And if you don't do that, and if any system errors comes and you suffer a loss, we call it technological risk, or I would say it's an information risk, which we will be dealing separately. So our entire course, now I have given you a complete background or identification of what is risk and what type of business we do and what type of environment we operate, and little bit from the history, what has happened or which lead to importance of our subject, which is a risk management. And I'm now going to break that subject into various parts in order to give you a better idea of the subject matter. So today I'm dealing with the number one, which is definition of risk and risk management. Next week, we are going to talk about integrated risk management. Integrated risk management is it's another area. I just explained you the type of risk. We are not managing a single risk. We are managing whole gamut of risk: credit risk, market risk, liquidity risk, operational risk, strategic risk, legal, various. To manage all these, you need to have one common supervision, one set of policies, one set of framework, and that we call it integration. That means you take the entire or separate type of risk into one platform, and we'll see how we can manage that. Therefore, we call in banking, it's an integrated risk management. In another institution, they might call it an enterprise risk management. So next week, we are going to deal with how do we do all this platform, because this is one of the first requirement of your regulator for bank to have a risk management framework, and that framework comes in the integrated risk management. Then I told you, in our current assets in our balance sheet, the largest item is loans and advances. Loans and advances, non-payment of loans and advances or non-recovery of loans and advances will lead to credit risk. So credit risk is a bigger area. It can come from customer defaults, or it can come from loose in internal controls and various evaluation mistakes done by the banks. Therefore, we are going to devote 2 sessions, that is third and fourth sessions of our 4 weeks. We are going to cover credit risk. Then we also have, I told you, in the current assets, we also make investments. Those investments are either can be an investment on treasury bills, treasury bonds, those are government securities. You also can make investments on stocks. We call it equity trading. Then we also can buy gold. We call it commodity trading. Or we can also undertake positions in foreign currency. Those are, we call it exchange. Those comes under market risk. And it's another major area which we need to discuss in detail. Then banks, in order to do our business and also regulate, imposes conditions that we need to maintain certain portion of our asset in liquidity form. And if you fail to do that, it will affect, we call it a liquidity risk. And therefore, liquidity management or liquidity risk management is also an important area. I just spoke to you about the operational side of it. Operations include personnel, systems, processes, events. Those may pose us certain risk, and managing those events, people, the processes, and the system will be dealt in the operational risk management. I also said, since we have different platform, IT platform, and our data need to be secured, therefore, we also going to deal with information risk management as a one module. Then in your risk types, the hub is the regulator. The regulator, we call it compliances by the regulator, and violation of compliances can lead to compliance risk. And we are going to deal with this. What are these compliances and how do you manage them is in under compliance risk. Strategic risk related to your customers, your competitors, how you deal with your strategic decisions, and that also need management supervision. We call it a strategic risk management. Then finally, I am going to touch another major area which I would say it's a corporate governance. Corporate governance is how your ownership or your board of directors behave in managing the risk component of the bank while doing business. This is one of the major area nowadays because board is directly involved in risk management, and therefore there will be a subcommittee appointed by the board of directors. We call it BIRMC, Board Integrated Risk Management Committee. And this committee, therefore your risk officer could directly report to the board of directors through this committee. Therefore, corporate governance or your behavior of your board of directors will also come under scrutiny of this particular governance, and therefore risk managers also need to see what type of related party transactions will take place, so on. So this is also another module which we identify. So coming weeks, we are going to deal with all the subject matter. Today, we are dealing with definition of risk and risk management. Now I have given you the definition of risk in various forms. Now we'll move on to the subject proper. Now you know type of risk we undertake in a bank, credit market, liquidity, operations. Therefore, now we have a thorough knowledge of what is risk and the type of risk involved in our business. So we'll see, we need also to give a definition to our risk management. Before that, I think I explained this to you while going through our subject. Credit risk is asset quality. Asset quality is your loans and advances. If they pay on regular time, your assets are in good quality. But if they don't pay, some of the assets will be non-performing. or we call them non-performing loans or non-performing assets. So your asset quality is determined by credit risk. Liquidity risk is also ability to convert assets into cash. I said your customers may demand their deposit any time, because all the deposits what you undertake from customers are mostly payable on demand. Therefore, you need to maintain liquidity. So your ability to convert assets into cash will be dealt in the liquidity risk. Market risk is adverse movement of interest rates and prices. So I told you some of the investments we make on treasury bills and bonds, they are gone by interest rate. Then we also make investments in gold. We can make investment in equities. Equities, there's a price, share price we call it. If share price goes up on investment, you make money. If share prices goes down, you make a loss. So that component is covered under the market risk. Then operation risk, I just told you, it's about processes, it's about people, it's about the systems and the external events. Compliance, also I explained to you, it's the regulator or the directions what you received from our regulator, Central Bank of Sri Lanka, and if you're not following, that's called the capital. Legal and reputational risk is when you do any contracts, and if you don't do your part, the other party can sue you. Capital or solvency is potential decrease in market value of assets due to microeconomic factors. Now, this is one of the major area under stress conditions. Now, we'll be dealing with the current situation. You know, banks has to evolve out of this COVID in a different strategy, and by protecting the capital, because we may not enhance our profits, whereas we need to maintain a capital adequacy ratio of 14% from this year. As a result, bank may need to raise funds, and when the economy is in distress, those will be a difficult factor. So that also we will deal with under the current context when we do our stress testing exercises. Then also in banking, we also have off-balance sheet risk. Now, in our balance sheet, I have only put current assets, fixed assets. Current assets are on-balance sheet items, but we also can make money through various fee income base. Like, you know, when we issue a letter of credit on behalf of a customer, what we give assurance to a third party that when you do your performance, we undertake to pay. So if an exporter sends the goods to an importer whom we issue the letter of credit, the bank, while issuing the letter of credit, money will not immediately go to the beneficiary, but we make an off-balance sheet record in our book. We also call it a contra entry. And that contra entry is also risk, because in case we call it, if your customer failed to pay the money, but whereas goods have come and you need to retire the LC, bank need to fund that particular transaction. So those off-balance sheet become a on-balance sheet item thereafter. As a result, what will happen is you make a financial loss. So moving further, anyone wants to verify? We have 57 people, or you all have 57 logged in. Anyone has we have this chat function. I don't see a single chat has come. Actually, so we are in the slides of market risk. Now, I gave explanation what it is. Market, our investment in the market constitute of your investment in stocks. So we do investment in stocks in order to see that the stock prices goes up and make a gain. But if stock prices goes up, it will end up in a loss. So this particular investments need certain calculation of the type of company which we are going to own in the stocks and their future earnings. Those things are done by the bank's investment committee, and managing that risk is based on company evaluation and future forecasts. That all the time any investment is done on a particular stock, bank will make sure that at least you will get dividends and the price in the enhancement of the price of the stock. Then we also do investments in treasury bills and bonds. Those are subject to interest rate risk, because you take a treasury bill, it will be for 3 months, 6 months, or 1 year, whereas the bonds we undertake can go up to 30 years. Bank doesn't want to make an investment for 30 years and hold on to that capital, because shorter term are our deposits, because all the deposits customers make need to be paid maximum in 2 hours of 2 years or maximum 5 years. So we cannot hold bonds which has a maturity period of 30 years. So these bonds are generally purchased to sell in the market when the prices improve. So prices in the sense these bonds are subject to interest rate. So you take a bond at a particular interest rates, and when the market interest rate goes down, you have a instrument which carries a high interest rates. Then what you sell, if you sell that particular instrument in the market, you make a gain. So that's how banks make the investment. So if interest rates goes up, what will happen is market trades has a higher, whereas your instrument has a lower. So if you have to sell that, you can sell only at the rate what is being specified, whereas market demands higher rate. So then you make a loss. Similarly, banks who are dealing in import exports need to maintain, nostro and hosto accounts. That means we need to maintain accounts overseas in the currencies of that particular country. As a result, we need to deal in exchange. So we'll say if you have a dollar account in New York, today if you have $1 million in that New York, that will be converted to the current exchange rate as at today, and that will be recorded in our balance sheet as our investment. But the tomorrow comes, and if the exchange rates goes up, you will be recording your balance sheet at the higher level than what the previous day. The difference will book into your P&L. So similarly, if rates goes down, you make a loss, because you are recording a low value in your balance sheet, converting your dollar value into the most current exchange rate. This risk is, we call it a currency risk. And generally banks will have to undertake this currency risk, because in order to do import-export facilities to your customers, you need to maintain accounts in foreign currency. So we generally call those balances in those accounts we call it a position. And so when you hold a position of foreign currency, that also will lead to a currency risk, because the exchange rates change overnight. Similarly, nowadays banks also buy and sell gold. Gold is a commodity. Overseas banks not only they deal in gold, they also can buy and sell oil. They can buy lead. They can buy various other type of commodities in the open market and hold them as a position if price improves to depart. Not that they are going to physically hold the um, type of commodity, they can hold papers of ownership. And when the prices move, they can sell that. Whereas commodity of gold, generally we hold in the gold form. And because we need to sometimes sell that gold direct to the local buyers who are in that trade. So banks generally, Sri Lankan banks generally mainly deal with gold as a commodity. So change in prices of gold in the international market also will lead to commodity risk. So market risk include equity risk, interest rate risk, currency risk, and the commodity risk. We are dealing each type of these risk at a later session when we take up the market risk. And I also told about the liquidity risk. It is liquidity is the ability to pay back when customer demands, and therefore it's a very appropriate to hold part of your assets in either cash or that could be converted to cash in short notice. So they say financial system runs on confidence. When the confidence erodes, it erodes quickly. That means, for instance, I'll put this in a better way for you to understand. We'll see, I come to your bank and I make a fixed deposit. We'll say I have 100,000. I come to the counter and place a deposit of 100,000. At that particular time, my requirement is to make money by way of interest, and also I don't find a reason that I may not need this money for the next coming 12 months. So I tell the bank, please place this 100,000 for a 1-year fixed deposit, and whatever the best rate the bank offers, I take. And what do I get from the bank? I get a fixed deposit receipt. In that fixed deposit receipt, what is mentioned? It has mentioned my name, has placed rupees 100,000, date of deposits, date of maturity, and rate of interest. So this is the binding document on the contract which I made with the bank. I depart with my 100,000 rupees to your cashier, and you give me this piece of paper, which is my contractual document that you have my money. And that contractual document has various conditions. You will also say that you will pay me with interest and my capital on maturity on a particular date. We'll take, for example, after 3 months, now I need money. What do we do? I need my money, but I know I have 100,000 deposit in the bank. I come once again to the bank and I say, I like to withdraw my money. Then looking at my paper, I know very well that I am not supposed to go to courts. I can't go to courts because courts will say you have a contractual document. You can only draw your money after 1 year. But I'm sure when I come to the bank, you will oblige me. You will give me money. You may charge a penalty, but you will give me this. Why do you do that? It's simply because what you see in this slide, when confidence erodes, it erodes quickly. That means when you refuse to pay, what you'll do, I will not go to courts, but I will see whether I will tell my friend, look, I have my money, I went to take it, bank didn't have money. Then the confidence my friend has with your bank also will erode. And similarly, if something happens of this nature where you unable to oblige a customer with liquidity and is required, you run into loss of confidence. And loss of confidence finally even might go up to run on the bank where you all depositors want to withdraw money. Actually, banks have a better way of dealing this. Bank will make more money by my deposits by asking me to take a loan. That's a different matter. So, but if I say no to a loan, I'm sure still you are going to give me because you maintain a huge liquidity position. You want to oblige my premature withdrawal. So this is where the liquidity risk is concerned. Bank will have to be very careful because every business what we do it in confidence. And if customer confidence is lost, no further business can be undertaken because customers' deposits will not come. As a result, our major or main raw material will erode and we may not be able to conduct business. So liquidity risk is a very important area. Operational risk, I think over and over I told you about, it's about processes, people. When it comes to people, I must say something. Banks need to recruit people, train people, and give them under strict code of conduct for them to operate because banks' importance of confidence of customer and the fiduciary duty of safeguarding the customer's deposits is lies on the people. People, I mean the employees. So we need to have people who are trustworthy because most of the operational risk factors come from fraudulent activities of the employees. So you need to have certain strict controls, you have audits. You can remember the example which I gave, the fall of Daring banks is due to a fraud. Instead of showing the losses, he hide the losses in a suspense account. So these are called operational risk. Operational risk also a major part of banking now, especially when we started our internet platforms other than the branch banking platform where customer now has the ability to deal with the bank 24/7. This also I looked at in a very broad manner, risk of regulatory sanctions, financial losses, loss of reputation, all suffers because of failure to comply to applicable laws and the standards. Now, generally, banking business is governed by the Banking Act. Banking Act it is 1988, Act number 30, which is fairly old, but you know what central bank does is, based on this act, they issue directions. So at this moment, I want to give you some homework. You go to the website of the central bank or you type on your Google directions issued to licensed commercial banks by CBSL. Then you will get all the, other than the Banking Act, all the directions what they have been issued up to 2014, I think. On your current page will come all the directions issued under up to 2014. You also can view another document under the same website, directions issued prior to 2013 in a booklet. And I suggest for you to, go to this particular website, download that booklet, and also look at anything relevant to risk management. Especially, there is one particular direction, direction number 7 of 2011. It is called Integrated Risk Management Framework for Licensed Commercial Banks. I want you to, if possible, do a print of this. And also, subsequent to this direction, there could be 1 or 2 amendments to this direction by the CBSL, moving from 2014 up to now. There will be at least 2 or 3 amendments to these regulations, and I want you to download those also. And because in the future, our entire course, that particular directions are the one we are going to follow. Because in our regulatory risk, those directions give us complete guideline how banks are managing their risk. So how banks should manage their risk. As a result, therefore, it's a very important document. If possible, if you fail, I can ask the institute to download that and send you across, or easily if you're on, now you're on an internet platform, so surely you can download this from central bank website. And I know at this moment you will not be able to comprehend completely on those directions what has been mentioned there, but when time goes on with this particular module, you read page by page and then you will understand very clearly this regulatory risk is give us guidance for risk management and also guidance how the bank should operate. So it's a responsibility, they say, of the board of directors and the senior management to make sure those regulatory risks are being followed. Generally, there's in a bank now, you are under risk management, you have a chief risk officer. Now they have gone into 2 other positions, the compliance officer, and the latest, I believe, is chief information officer, because they also consider information risk also another area which bank need to safeguard. So 3 senior people of the bank are involved in compliance, risk management, and information risk management. Therefore, that we make sure risk management functions of the bank will go integratedly, and those integratedly means you are abiding by the directions given by the regulator, because that particular direction goes integrated risk management framework for licensed commercial banks. So I believe that you could download that and make sure when we progress in our course, that will be a real helping document for you to understand better, especially since we are doing online training, and online needs some kind of support from other documents rather than just looking at slides and what I'm saying. Therefore, that will be a greater guideline for you to continue studying. Now we looked at type of risks. Now we are going to look at risk management per se. Now, risk is a chance, it's uncertainty, your objectives not be achieved. Now, what about management? I'm sure all you are aware what is management is. Management is, planning, organizing, using the resources available, and trying to achieve objective. In banking, it's a profit. So you use customer deposits, you have loans and advances to grant, you have a process to follow. When you do that process proper, your profits will accrue and you will get your bonuses and salaries. But risk management, if I am to give you a definition, it's also a process. And this process starts with identifying what is risk. And then once you identify, you need to measure. That means you need to do some sort of calculations. You need to know how much you are going to lose or how much you are going to gain based on the risk in that particular process. Then you need to do a respond. Now, respond means you have to say yes or no, or accept or avoid. In banking, we generally, in our papers, we say approved or decline. So this process starts with identifying what is risk, then you do a calculations and see whether we are going to make profit. If you are going to make profit, you respond saying that you approve that transaction. If you are going to make a loss, you will tell the customer, sorry, we cannot go through with this. Therefore, we decline your proposal. So that is the process, identifying, measuring, responding. But if you stop at that level, still it's going to be a risk, because any transaction we undertake, especially credit risk, need monitoring. Your investment that you do on market risk also need monitoring. You need to find a time, if the share prices goes up, either to dispose your shares or to retain. So that decision has to be made through monitoring the prices. Especially credit, you need to identify the customer whether his installments are being repaid on time. If not, you need to take further action. Then if once 1 year goes, you have an annual review. All that is, we call it monitoring. Then while monitoring, if you find that your objectives cannot be achieved, and by going through this particular process, you're going to make a loss. Sometimes you need to make a full stop. Like, a customer who has given an overdraft, he'll say 1 million rupees. If he's going above his limit over and over, what do? You take the stick. You will say, look, either you enhance your level of borrowing through additional securities, or we are going to control your limit to the current status. Similarly, your credit cards, they will monitor the transactions of your customer, and if he's always asking enhancement, and if he's good, you can enhance, but if he's finding it difficult to pay, that's the time you need to control. So risk management will give guidelines for those particular departments by issuing certain controls. Like your business transactions, you report to your senior management. Risk management also need a kind of reporting, and this reporting has to be done not only to senior management, it has to be done to the board of directors. So your chief risk officer will be involved, direct reporting to the board of directors. So he need to identify risk, measure, respond, monitor, control, and report with the objective of strengthening the financial strength of the bank. That is, therefore, risk management is a critical function. I told you this initially because a lot of people think risk management department, what is it? It's a back office function. They don't involve in business transactions. They don't make profits. But remember, they cut down losses and also will support the business unit to make more profit by identifying risk and alarming them the way how they should do business. So this process of identifying, measuring, responding, monitoring, controlling, and reporting is the definition which I can give you for the risk management function. Now, to do that, you need to know the type of risk you are going to manage, which we have already studied, because those type of risks to manage are credit, operational, market, liquidity, compliance, and so on. Now, just before coming to this slide, on the regulatory side, I gave you a homework. That homework is on this slide. It says Banking Act Direction number 7 of 2000 requires this licensed banks adapt an integrated risk management framework. Now, when you download this and keep this particular document, because our next week's lecture will be on the integrated risk management framework. So, what the central bank is asking us to make an integrated risk management framework through this particular direction. So that we will discuss next slide. The integrated risk management framework provides necessary policies, methodologies, structure in managing all types of risks across the bank. And in another 10 minutes, I think we will take a break. And before that, now this risk management should be viewed as a third leg of shareholder value. During this break, I would like some of the chat functions to be used, because so far what I have spoken about little over 1 hour, I need to understand that you understood what I said. Mainly, what is risk? What are the type of risk a financial institution undertake? And what's the process of managing that risk? These are the 3 major areas to summarize what we have already learned about last 1 hour, 1.5 hours time. So, or 2 hours rather. So 3:30 we are going to make a break. I think during that time you can type out your chats. So I'm going to devote a lot of time, because these chat functions will give you, I'm going to read those questions what you pose for all of us to know, and then we have a nice dialogue so that you understand the subject matter proper. So they call it risk management should be viewed as a third leg of shareholder value creation along with revenue growth and productivity. Now, if I have to go back my slides, you'll see this slide again. Profits, growth and risk. Banks are there to make profits. Any company for that matter, any institution, the objective is to grow whilst making profit. But while doing that, they have to undertake various strategic decisions that involve risks. So managing these risks well, and those are the companies which are going to grow faster, and profitability is being achieved as planned. So you have to consider the shareholder value comes from the profits. Shareholders will get their dividend from the profit. That profit can be enhanced only through proper risk management. Therefore, as a result, now banking, they find that risk management is a very critical function. Regulator is addressing very critically how we manage, and if you don't manage this risk, there will be great losses, and those losses will involve your depositors losing money. Also, people might, in fact, they might tend to keep the money at home rather than depositing in banks because they don't want to lose their deposits, or I would say financial institutions. As a result, regulator also play a very big part in risk management because they don't want financial institutions to fail just because they are unable to manage their risk. As a result, the regulator always guide, give directions, and sometimes those directions come by way of very strict instructions. You need to abide by these regulations. Non-compliance is not tolerable. I take a position here, the liquidity. Because of this COVID, liquidity was eased by 2%. That means um, we have a statutory liquid ratio. That means it's a legal means. Central bank says you need to keep 21% liquidity ratio at all times. But when you have liquidity, what will happen if you have to keep liquidity? The other side of the story is amount of money available to lend to customers get reduced. If you look at my board when I displayed earlier, I will show it again. You can see 69 out of 100 total assets have been lent because 21% is kept as either cash or other liquid investments. So you maintain 21% statutory liquid asset ratio. When central bank wants to help the customers who have been affected by COVID, what do? They said they ease the liquidity requirement of the banks. I think liquidity requirement was eased by 2%. Now bank doesn't have to maintain 21%. If you reduce 2% on that, it will come to 90. Then what will happen? Your loans and advances, which was earlier at 69, now it can be raised to 71. As a result, that additional 2% of your total loans and advances will now go back to customers who want to borrow and make the economy right. So government's plan is also, those directions are to make sure that the economy, when the economy is doing well, banks will do well. When the economy is not doing well, but banks will have to make sure that additional money what they pump back to the economy should be recoverable because you need to give loans to people who pay back. So evaluation of those loans need very careful study and careful evaluation that need to be done. I have a question. Let me see. Shiham Bakir. Sir, could you please discuss exam questions? Very good question. Definitely, I'm going to devote the last session before I conduct the exam about past papers. You all are not in a position at the moment to rightly understand the questions which may come in your exam. Therefore, I think Shiham, I'm going to discuss that, so you don't need to worry. Time to come, we can do. Then Ajipan wants to know the homework. What I want you to do is to download. You go to Google and type directions by CBSL, directions to licensed commercial banks by CBSL. Then you get a website that will have all the directions which have been issued by central banks to licensed commercial bank, out of which it's a very vast document. So you only, I think, highlight the risk management area and copy into a Word document, which you can copy and keep it for your future reference. Then Dulshinder Ulsan, you want to know what is off balance sheet risk. I take a small example here. You know, the contractors who come for credit facilities, sometimes their total package will include direct loans, and also they will ask guarantees from you. So what do you do in a bank when we issue a guarantee? Sometimes we keep a margin. Sometimes we place that guarantee limit also under his full set of facilities. When you issue a guarantee, you are not giving money direct to the beneficiary. You give a piece of paper. And that paper, since it has no value, that cannot be put into a balance sheet. When anything what you can't put into a balance sheet by way of monetary value, we record it as a off balance sheet item. In your records, we call this a contra entry. And if any transaction undertaken, like letter of credit, guarantees, all these involve off balance sheet risk. Risk is that you have issued this guarantee, and on its maturity, if guarantee is not being returned to you, that means there will be a claim on the guarantee. What will happen when the beneficiary claims? Bank can't say my customer has not placed margin on this. Bank need to honor that. We call this crystallization of a guarantee, and when it crystallizes, that will involve financial transaction, and that financial transaction, whether customer pay or not, bank need to make it and debit the customer, but those may result in losses in the future. So off balance sheet risk is such: when a claim crystallizes or claim has been made, and if you don't have adequate cover to meet that claim, we call it a off balance sheet risk. I hope you understand. Now we are going to stop for a break, and we will restart. We'll say, I think they say we are going to restart in half an hour. I would like to have your questions as much as possible on the subject matter which I have covered now before we proceed. On the chat one, I can't see any new ones other than what you have posted earlier. So going back to my slides, we are on risk management slide, which finally I said risk management should be viewed as a third leg of shareholder value creation with the revenue growth and productivity. So I move back to my slide, earlier slide, which was showing profits, growth, and risk. So risk management mainly is a process. So first you need to understand, I will write again on the board for your easy reference. You see this process, risk management is to identify, measure, respond, monitor, control, and report. So this is the process which we will be studying under each type of risk which we have earlier mentioned. Where financial risk is concerned, we are going to do on credit, market, and liquidity. Then we also will touch operational risk, we will touch strategic risk, we will touch regulatory risk as our major components of risk types in the type to come. So this process of identifying, measuring, and reporting and responding, monitoring, control, and reporting will be applicable to each type of risk bank undertakes in the future. Kindly, I also got another one. So kindly explain against the about off-balance sheet, which I think I replied to you. So we'll move on to our slides once again. Now we said in this process, risk, the first process start with identifying. Now, I have written a nice thing for you. When sun is shining and no clouds are on the horizon, or businesses on growth, is the right time to think that what may go wrong. So generally we think when economy is doing well and when the business are booming, we don't think about the risk. We think these things will move. I think somewhere in January, every direction towards economic factors in Sri Lanka was on the upward movements. We were thinking share prices will go up, exchange rates will get stronger, rupee will get stronger, and then development will take place, roads will get built, new apartment complexes will come. So everything was on the right direction. Trading was taking its normal course, importations were done, exports were booming. So all sort of things were on the positive direction. We never thought, then I would call it, then that time is actually sun was shining. But what happened? We never thought any clouds will come. One external event out of blue came the COVID-19. Now what happens? Everything has got changed, because in risk management, if you have identified that this sort of things will affect us, and if we have taken precautions, we could have done better. I think as far as the world is concerned, Sri Lanka has done better, because I think our identification process and measuring process and also the responding process were on the high alert for the risk which is going to posed by this particular epidemic. So I think as a result, you can see number of cases were something like 2,000, out of which 90% people have got cured, and only 11 deaths compared to the large number of deaths, so about 500,000 in the world. So Sri Lanka, where risk management is concerned, I think I would say must give 100% credit to the people who are involved in the process. But what happened is we were locked down. As a result, now we have another situation in the horizon. What is it? Businesses to start again, banks to lend. What the central bank is now doing is they have eased the liquidity, ratios been allowed. They are asked to banks to fund it, pump more money into the economy so that people could avert economic disaster. So, what will happen? There are certain businesses, certain industry segments were very badly affected. Those industry segments, if you have given credit, and those loans are going to go NPL. So now it's time for banks in their risk identification, they may need to think to whom are you lent, what sort of investment we have given, whether those industries are going to get back into their normal type of business and making profits for us to pay back their loans. You can imagine if a bank has been exposed to very high stock market contribution in their investment portfolio. Stock market was dropped by almost about 15% drop. So if you have invested a million, 15% capital would have been now in jeopardy. So banks, the profits what we used to forecast for year 2020 may not be achieved because of the risk factors involved in COVID-19. Even now, it's not too late to identify the businesses which have been affected by this particular epidemic and take precautions that we may not put our good money after bad. So I think our first process is required even at the current stage. Now, risk identification need a lot of scenario analysis. What will happen next? You need to conduct a test called stress test, which is a part and parcel of risk management process. And also see, based on your assumptions and your computations, how much money we are going to get. We may have to write off in our books or forego our profits based on our budgeted. So we need, in this situation, we need a lot of brainstorming sessions. Banks need to conduct workshops and to see which type of risk has doubled during this COVID-19 period and take necessary controls. Also monitor what are our exposures very well. Just imagine the currency rate of something like US dollar to rupee somewhere in January, it's about 160. Now it has gone to about 189. Simple reason is rupee has got depreciated. So if a bank has forecasted this, most of the banks would have held credit balance in their foreign denominated accounts. But unfortunately, you can't hold credit balances because you need to pay for your imports. So banks which were lucky enough to have positive balances in their foreign exchange would have made exchange profits. Others, they have suffered exchange loss. So risk identification is required when the things are normal. You need to identify if something of this nature happens, what will be the impact on our profits. So this is the first step of our risk management process. To identify risk, you need to have good knowledge about the business lines, the events that will affect and impact those business lines. And you need to have thorough knowledge of industry sectors on which we have exposures. So you have to segregate each type of risk and see what exposures we have in those. Now say in our balance sheet, we say our loans and advances are 69% of your total assets. You need to analyze and see how much money out of this 69 has been gone into tourism, because at the moment tourism is one of the industries which is badly affected, and we need to check with those clients kind of a rescheduled repayment program. Otherwise, we are going to have a lot of NPAs in our loan book. So these sort of things are called risk identification. Risk identification needs various exercises. Banks will have, brainstorming sessions or workshops uh, relating to a person who is a master in that particular trade, discussing with others this sort of a situation, and how do we foresee mitigation techniques to overcome those. So risk identification is a major part of risk management. So we have come to the last slide of session 1, which is in our process risk identification. Before going into the risk measurement response, I want to go for our integrated risk management framework. But however, though I don't have slides, I will talk about the measurements procedure. If you see the board right behind me, risk management process is there. So now we said risk identification we have touched. Now risk measurement is a calculation, generally involve numerical calculation to see how much, or to quantify the profits or the loss we are going to make out of that particular transaction. So risk management is to identify the risk, and based on that identification, we will see how much money is going to lose. I'll take an example. Now, you have a customer who wish to borrow 1 million rupees for a loan, repayable over 5 years, and now evaluations have been done on this customer by the usual credit process, and credit business unit has recommended this facility to be given to the customer based on their financial evaluations and qualitative evaluations. Generally in banks nowadays, dual approval system works. That is, such a credit proposal, especially the large value credit proposals, are also being approved by the credit risk management unit. So now this proposal is now being referred for credit risk management team, and credit risk management team also need to go through the risk management process. The first one is to identify. So they will read through this proposal, which will be a credit appraisal form, and see what industry this particular customer belongs. Then they will see what type of, whether that in particular industry is doing well. Now say if you take post-COVID, if that proposal is to build another hotel, what will happen? Because in your identification, you see this particular industry will have certain risks. The future will not be bright as it was before. So in your identifications, you will see difficulties in these particular type of customers. If you allowed facilities to them, the business risk what they run, or lack of customers and the business risk what they run, may lead to non-payment of your facility. Now, You say that the proposal what you have got has done the initial evaluation. Initial evaluation is equivalent to a risk department doing a risk identification. So now you have got the business people recommending a loan. Though I mentioned it was tourism industry, maybe this one come from other industry, otherwise your business unit would have recommended. So you have a paper which risk has evaluated in business unit, but now you also go through the paper and see, identify what happens to this business, whether there will be future regulatory restriction on the business, what are the competition it is in, is your customer. Then you go in to the next step by measuring. Measuring means to see whether how much you are going to lose or how much you are going to gain. Because in this proposal itself, they will identify the interest rate. But interest rate will give you a definite future profits. Together with capital recovery, you will achieve the objective of granting this loan. But if this customer default during the course of the tenure of his repayment period, you might get deprived of interest or even capital. Based on that, you can do a measurement saying how much you are going to lose. This particular measurement is in credit risk, we call it probability of default. So you do a certain calculation based on the customer rating. I will come to this, what is customer rating and how do you do customer rating when we reach credit risk management. But to give you a rough idea of how it measured, we will see if this type of a same customer has the same industry, who has the same rating, who has the same credentials. We'll see in the past to see how such a loans have been performed. If such a loan has been defaulted after 4 years, when your balance is, say, 1/5 of the total capital, what you have granted. We'll say if you have granted 1 million, 1/5 is about 200,000. He has service 800,000 and now balance is 200,000. And at that moment he defaults. So the capital outstanding is 200,000. Now future interest also may get default. If you have granted this facility clean and you find it difficult to recover, you tend to lose capital as well as future interest. So your loss would be 200,000 plus the future interest. Now that is the measurement we want to arrive at. How do you measure that is, you look at the same type of customer who has the same rating in the past, how it has behaved. You can, based on such, you can actually, if instead of giving this facility clean, when you measure, if that you identify there's a possibility that this customer will default after 4 years, and at that time 200,000 will be outstanding. Best thing is to at least cover yourself. We call it risk mitigation. So your response, your risk measurement gives a figure of 200,000 loss with future interest. So your response should be, you also agree with the business department to grant this facility because their evaluation is right, but you see a probability of default. To cover that, we call it a risk mitigation. So your response can be, you approve this, subject you will have at least security cover to mitigate that loss what you intend to have in your probability of default. So now in one instance I covered two, how to measure, how to respond. Now measure is kind of a calculation based on different formulas we apply. So this will apply to credit, a different formula. We apply different formula to market risk, so on. We have different techniques in measuring this. and those techniques also will be dealt in future classes. We have technique called value at risk. We have various simulation exercises. So we will be discussing this. At the first class itself, I don't want to, put everything on you. So respond is approved based on if measurement is right, your identification right, you approve this facility, which is we call respond. Now, going on the same credit line, thereafter, now this customer, the past record of a similar customers with the same rating, you expect 4 years to pay. By monitoring, you could avoid that. You could do a review of this facility on a frequent basis. You can check whether the repayments are on time. You can make a business visit to this customer to see how his business is doing. You can call for financial statements of this customer's business more frequent than annually so that you can see the financial position of the business. So monitoring is, you see the risks you have identified and you have responded. Once you undertake that particular risk, you need to monitor. So where we took example of credit, monitoring requires greater emphasis in order to get your money back. So once you do monitoring and still you find weaknesses, the customer, even with your hardest checking, you think it's going to go bad, then you can have controls. You can request customer, or you can stop all enhancement. You can see that your collateral has value. So those controls you can put. Or any future expansions, you can ask the customer, we need more contribution by way of equity. Such controls you can apply on your review date. Sometimes banks, even based on high risk, they can call up the facilities also. So instead of suffering a loss at the end, while monitoring and controls, you can reduce the loss. Reporting is also very important because this what risk what you identified not on individual basis by way of type and your measurements on a large scale and your responses what you have made to those need to be reported to your senior management. And where in risk management is concerned, it need to go up to the board level. And therefore, there is something called quarterly meeting of board integrated risk management. Before that, you will have various other committees in between actually people who risk manage and the board level. Various other committees also need to know what's happening in credit area, what's happening in market risk area. So you need to report all these incidents there. So this is the process we are going to follow from next class onwards. Now, again, to summarize what we had done today, is we gave a history of how the risk management came into being based on certain banks falling. Where Sri Lanka is concerned, you also have cases. Those cases may be different from what we have already discussed with you. For instance, now even in Sri Lanka, we have cases, banks have failed. Not the licensed commercial banks, we have certain banks like Pramuka Bank. Pramuka Bank had failed because their license got cancelled by the regulator for violation of compliance risk. And that's what I said, compliance risk or the regulatory risk is very important. But the customer's confidence in the particular industry depends on how the banks act. Banks has a fiduciary duty to safeguard customers' deposit. If your bank doesn't do that, regulator has the right to finally cancel your license. So that is what. Then also there are, I want to touch on this before we move on to integrated risk management. One area where great examples occur in 2007. In 2007, there was a world financial crisis. And as risk managers, we need to know how it started, the causes of that crisis, and thereafter what the regulators or the World Bank or what they have done. Now, in 2007, before that, they have identified the risk of banks, and there were certain international rules. If you have heard of this word called Basel, Basel is actually a township in Switzerland, where a team of World Bank representatives met, and they found that they need to have one unique formula how banks can be managed without, upsetting the financial system in that particular country. So this particular incident in 2007 was a financial crisis of the world. But before that, in 90s, this representative of World Bank has met in Basel, and they brought about accord. That accord, we call it Basel I. And Basel I, what the international body identified, banks could fail if they fail to manage their credit risk. So they brought about saying, you evaluate the bank's credit risk, and they say that can be mitigated or that can be managed or avoided only by having larger capital equal to the risk they undertake in credit. So the Basel Accord 1 was only considered major risk in bank is credit, and they impose percentage of credit risk or the weighted average of credit risk in the total loan book. They wanted 10% of that, at least you should have capital. That was the idea given to that in 90s, late 90s. In 2004, this committee again brought about a Basel II Accord. In that, they also said it's not only credit. In your market risk and your operation risk also will contribute to collapse of banks. Therefore, you need to have additional capital to cover those risks also. So they also calculated the market risk, they also calculated the operation risk, and then they brought about a formula saying to cover all those risks, banks should have 10% of their capital. So when this 2007, banks were under the Basel II Accord, which they computed credit risk and the market risk and the operational risk. Despite that, in 2007, this world financial crisis brought about a lot of bankruptcies in banks. There are times, in a given day, there are more than about 145 provincial banks of USA declared bankrupt. The root cause, they call this particular crisis a subprime crisis. Now, to explain what is subprime, I need to tell you we need to categorize our customers into various classes based on their income, based on their financials, based on their qualitative aspects. Generally, banks classify their customers and give them credit rating. Now, the big customers could go to a independent credit rating agency and get this rating. Now, for example, Fitch is a world-renowned credit rating agency. You get Moody's in Sri Lanka. We also have another rating agency called ICRA. All the banks are actually now under the regulator. You must have a rating. Similarly, we also in risk management, we also promote all the customers should have a rating at the bank. In USA, they have all the customers, including individuals, have a credit rating. If you walk into a bank, if you are an employed person in USA, your income will be recorded in a national computer, and when you walk into the bank, you give your identification, they can get a credit rating for your customer immediately, because your payments, your income all get recorded in a centralized information system. Based on that, they can give you a credit rating. Now, these credit ratings are generally, I would say, triple A, double A, then triple B, double B, B, and C. C is they call it a non-investment category. If you have got a credit rating C, that means you won't be considered as a credit-worthy customer. Now, these ratings are arrived from various computation based on your income, based on various aspects of your credibility to your qualifying status of getting credit. So, generally, what we give is, when we come to credit risk, I will further explain this. What we give is, you give certain marks based on your credit worthiness. If those marks come above 90, you get a highest rating, which is called AAA. If you have got between 80 and 90, you get AA. If you have got 70 and up to 80, you get A. And these A, AA, and triple A are customers whose creditworthiness is established, and we call them prime customers. And generally, defaults are very low on these prime customers. And when rest below that, if you have got a rating below that level, you get, they call it subprime client. And in USA in 2007, the government wants to increase the living standards of people. They want actually the living standard, what they want to increase is to have people to have their own home. The US culture is that, it's different. Now in Sri Lanka, our main aim is to, build our own home. That's one of our dream all of us has. So in US, they like to spend what they have earned. As a result, they will live on a rented premises throughout their life. Now, this particular thing was affecting the standards of living. Therefore, US government wants to, people to own their homes. They requested banks to increase their quantum on housing loans, and to support the banks, they started giving interest rebate to the banks. That means if the interest rate on housing loan is 5%, if you grant a 5% loan to a customer, government will give a 1% additional interest to the bank. So bank will not only by lending money, they will earn money from the bank, but they also receive a rebate from the government. So banks got very greedy. And as a result, those days they were funding customers who are rating A, AA, AAA, prime customers. Now the rebate is coming. So the banks thought we can earn more money by giving housing loans as much as possible, and they started lending into customers who had gone below the prime level to subprime level. Those customers, their income is generally, they are on a very tight budget. And in colloquial language, if I put, they run on the rim. rim එකෙන් දුවනවා කියන්නේ මේ customers ලා මේ ඒගොල්ලන්ගේ earnings are good enough to to live on. So they can't do any investments. All the earnings what they earn is required to spend for their living. They need to pay for their gas, they need to pay for their transport, they need to pay their... So on top of that, if these people are burdened with the installment of the housing, sometimes their living was become difficult. And during this 2007, there was a very severe winter in USA. And in winter time, you need to heat your houses. So you need to spend a lot of money on gas. On top of that, oil prices in the world market also shoot up. And as a result, fuel prices in USA also went up. Then it was very hard on the people. What they did was they managed living by paying high amount for gas, high amount for transport, all that. And then they were left with less money to pay the bank installment. What happened is obvious. Then they will default the loans. And there was a time all these loans who was taken by subprime clients got defaulted. And in USA, if a loan is default on housing, they will only wait for about 3 months, and you can find a board in front of your house. Your house is for sale. So the law is such, they don't have to go to courts and fight all this. They will get a direction from the court and they will sell your property. So similarly, at this point, most of the houses in certain streets had a board in front for sale. Then what happened? The prices of properties also got dropped. Generally in Sri Lanka, the real estate get valued higher. But what happened here, there are so many properties for sale. The supply was so much higher than the demand for it. As a result, the prices dropped. When the prices dropped, the realized value of loans coming out of sale of those properties was not even good enough to pay their loans. So once those monies are realized, still the customers can't pay. Property is being sold. Money what they have got is not enough to cover the loan outstanding. As a result, bank suffered huge credit risk and huge losses. Because of the greediness of that rebate, they not only deployed the customer deposits in funding the housing loans, they started going to investment banks and provided those mortgages as collateral. Those mortgages what they have taken on housing for other people as collateral, and borrowed more money from investment banks to fund the housing loans. Then they couldn't pay the investment banks. Those people filed petitions. As a result, most of the banks were declared bankrupt. And this led to world financial crisis. Therefore, you understand that time we also had international accords on credit risk. We also had on market risk. We also had on operation risk. Despite that, we faced this world financial crisis. However, Sri Lanka is not that much affected because our banks have not gone to investment banks and borrow, and our property prices didn't affect. As a result, we could survive the world financial crisis, except certain customers ours suffered because in America, when the customer get affected, they lose employment, their consumer behavior will get affected, the buying power will get affected. So the people who trade, send garments and various other things for sale in US, their orders got cancelled. So those factories who borrowed money from banks here were to a certain extent got affected, but not very majorly. So this crisis has led to various other accords to come, and they tighten up the risk management processes by banks by bringing in Basel III, and we are going to also have a study on those new accords under Basel III in our future programs. And so risk management, now I gave certain examples in the past, and once again, to conclude today's session, I thought to summarize in very basic form, risk is a chance or uncertainty. And especially those who are in business need to take risk. And when you take that risk, there is a chance that you will get positive results or negative results. We always expect positive results, but if the risk factor is higher, that could turn into a negative, and negative means we will have losses. Therefore, risk management has become a very critical area where financial institutions are concerned, and as a result, we have to manage not only a single type of risk, we have various types of risk. We call them credit risk, market risk, liquidity risk, operational risk, strategic risk, statutory or compliance risk, legal risk, technology risk, reputation, all that are different type of risk we need to manage. And risk management is a process, I told. So how we are going to manage is, we identify the risk first, then we'll see the measure of this risk, and then we need to respond. When you are measuring, if you are going to make a huge losses based on our identification, sometimes our response could be to avoid that risk. Or in other words, if there's a paper on credit, we decline that facility. If you think, even with that risk, if we can have certain securities and mitigation things, still we can make money. You approve those facilities or we respond positively. Then I told you, if you respond positively, if you keep quiet at that level, that won't help. You need to monitor, control, and do the reporting of risk for you to complete the risk management process. So next time we are going to integrate all types of risk in a kind of a framework which our regulator central bank has given us guideline to prepare based on direction number 7 of 2011. So my homework to you is to download that direction. Just have a glance, because I know at the first class itself you may not be able to comprehend fully about the process of this particular direction, but just glance through this and see. In that you have mentioned the type of risk. What I have told you in brief, it is there, but we will be studying next time the integrated risk management process, and to do that, I think you may have in your other set of slides the session 2, the integrated risk management, which is also same, which they say is affected by the bank's board of directors and the management. So you see involvement of all employees, including the board of directors, in this process, applied in strategy setting across the bank. That means This need to be communicated to each and every employee. They must understand. So risk management has become everybody's business. And generally nowadays, if you ask for an employee, what do you do? I think answer should have been, I'm managing risk in the bank. Because every process every business unit you represent has certain type of risk. And you may be from operations, you may be from credit, you may be from international. There are various type of risks associated in your type of assignment or the business. So we are going to touch that in a integrated manner. We are going to combine both all this in a framework and find one kind of solution. How do you manage this? Because they say it has to be effected by the board of directors and also management and other personnel. Other personnel include all the employees across the bank. That means it may need to even branch staff need to understand what is risk. So bank staff has now become risk managers because every type of transaction you undertake has a risk. For example, even a cashier who accepts a deposit, if that person doesn't follow the process of validating that deposit receipt, putting his money back based on denominations and checking the deposit slip for correctness, he will run the risk of that particular process. So every process you are in, you need to manage risk. So we are kind of risk managers now. So your employment demands to understand the type of risk a bank undertake. And if you are in credit department, you need to have a thorough knowledge of credit risk. If you are in treasury, or you need to know what is market risk properly. Then if you are in operations, you need to know what are the operational controls you have, what are the guidelines given to manage transaction without errors. Then how do you need to, if you are in audit, you need to stop any fraudulent activities. You need to see that staff follow all internal control methods which have been given by the management. So every department has a form of a risk management function. So I believe you have a fairly good knowledge of today's session. That is identification, that is definition of risk and the type of risk a bank will undertake in their business lines, and also the process include management process include identification, measuring, responding, monitoring, control, and reporting. So with this, I would like to conclude today's sessions, but we have little more time, and if you have any questions, please do type on the chat. I could read. Actually, the second session, I haven't seen a single chat, whereas some members have already left the session. So I will hold on this for about 2-3 minutes to see whether any queries are come, and then if not, we will conclude. And I hope to see you next week. And please log in and remember the exercise which I gave you as homework, which is to download the website directions of Central Bank of Sri Lanka. Thank you very much.